Ever wonder why so many accounts on Wall Street bets end up looking like this? You might think it's because their strategies are retarded. And while you're not wrong, what if I told you that the real problem isn't in the strategy? What if it's in your own brain, literally being hardwired to make you lose money? I came across this fantastic post in the day trading subreddit by user ChemicalTrain9439 that perfectly breaks down the psychology of failure. Today I'm going to break down the 3 brain glitches that absolutely are murdering your account. As always, this is not financial advice, but if you're watching a video like this, I know that my disclaimer is not going to stop you. These 3 brain glitches are very real, and if not guarded, they can murder your account. The first is the disposition effect. The TLDR of this effect is that you naturally hold losers for too long and sell winners too quickly. The psychology here is that we get some sweet, sweet dopamine from even just a small profit while holding on to our losses forever, just praying that we can somehow get back to our entry point. Think about it. Let's say that you put $10,000 of your hard-earned saved cash into a stock like Apple. The next day, Apple jumps up like 3% on some good news. Now imagine the opposite case. What if there's some bad news? Kind of like in real life right now where people are realizing that this liquid glass absolutely sucks and the stock drops 5%. According to a study conducted by Terence O'Dean in 2002 called Volume, Volatility, Price, and Profit When All Traders Are Above Average, which is a study on overconfidence and salient, which is the boomer word for meme value, indicators as opposed to more statistically important ones, such as price over earnings ratio. It revealed that traders generally sell their winners 50% more often than they sell their losers. This is because losses hurt generally about 2.5 times more than the equivalent gains feel good in your brain. Because of this psychological bias, which we also call loss aversion, your brain literally tricks you into avoiding the pain of a realized loss, since it feels less real of a loss if you just hold. The disposition bias is definitely the worst of the 3, destroying more accounts than any single strategy flaw alone could do. Next up, we have the confirmation bias. For this one, imagine an echo chamber. You only see the information that confirms your trades because that's all you want to see. Your brain is like the hype man for your own ideas, no matter how retarded they are. Once you buy a stock, you'll subconsciously seek out news and posts that confirm you made a great decision, equally ignoring and dismissing anything that says you might be wrong. Long Bitcoin, all of a sudden, every article you click says that it's going to go to $1 million. A study performed by the University of Texas revealed that while traders give 50% more weight to confirming opinions, the same traders chose to read supporting news articles, whether bullish or bearish, based on the underlying given their position. 85% of the time, they chose the supporting news articles over ones that challenged their beliefs. That's over 6 times affirming news article for one challenging one. Given this bias alone, it makes sense why so many traders go all in on a single stock and then end up going down with the ship as they ignore stronger contradictory evidence. The final bias we'll go over today is the overconfidence and self-attribution error. Hit that subscribe and like button if you're liking the content so far. The TLDR of this one is, think of the last trade that you won. Do you think it was because of luck or because you yourself were a genius? Now think of the last trade that you lost. Do you think it was bad luck or market manipulation or some other entity, God, the universe, laughing at you and purposely making you fail? Or is it just because you lack the skills or are retarded? The study supporting this psychological bias was also performed by Terence O'Dean, the same guy who performed the overconfidence study we just went over for the disposition effect, along with Brad Barber in 2011, in a study called The Behavior of Individual Investors. The long and short of the study is that overconfident traders achieved inferior returns and traded excessively, racking up fees and losses in the process, ultimately drowning their trading account. Now, the data regarding these 3 psychological biases should terrify you. The end stat is that 97% of day traders who traded for 300 or more days ended up losing money. That's just slightly better odds than a literal casino. Only 1% are profitable after fees, so out of the 3% that actually make positive trades, only a third of those are profitable enough to overcome the small fees that add up from a brokerage. The majority of these failures are easy to blame on poor strategies, but in reality are more often than not a result of these poor behavioral psychological patterns. To compound onto the massive disadvantage you have when you enter the market as a new trader, the nail in the coffin for most traders is ironically beginner's luck. Early random wins can create a false sense of confidence, and you begin to increase your positions as you think you've got all of this figured out. Like they say in Wall Street bets, the first one is always free, and a few sweet, sweet tendies can be enough to have you hooked for life. Next thing you know, your risk tolerance has grown way beyond where it should have, and you've started to gamble. Sooner or later, assuming you haven't patched your brain with the newest software update and therefore have these psychological biases in play, 97 to 99% of the time, reality eventually hits, and within several months, if not less, your account is blown. Does this sound familiar at all? Here's a quick self-assessment that you can perform on yourself, and it requires total brutal honesty to see whether you've been trading psychologically optimally or retardedly. When you start to win in a trade, do you already have a profit target that you stick by? If so, put a point in the logical trader column. If you're tempted to cut the win quickly and then take profits or increase position size, put a point in the hopeless degen column. The second question is, after a losing trade, do you rashly take out a huge position in hopes of making the comeback or the revenge trade? Trying to make back losses quickly is an easy way to keep sliding deeper and deeper into an unescapable pit and an eventual margin call. Thirdly, do you check your positions obsessively? I gotta be honest, this one kind of called me out. Even I fall for this. Even on my Investopedia paper trading account, I find myself checking the returns and making rash trades on the daily. I've already done like 3 today, and it's only 1 p.m. when I'm filming this right now. The final question is, do you find yourself consistently taking responsibility for both your wins and losses, or at least blaming them equally on forces outside of your control? Or do you take credit for the wins and then blame the market for your losses? If you answered yes to really any of these 4 questions, then your own psychology is holding back your account and possibly butchering it. So how do the professionals, the 1%, the 6'5" finance Chad who stole your girlfriend, that type, how do they avoid this psychological bias that you're falling for? OP suggests in his post that it's all about building systems to defend you from your own brain. The first major point is keeping a trade journal, literally writing down your emotional state before entering a trade. This gives you an opportunity to realize in hindsight when you enter trades you shouldn't have because of psychology, and also a way to review when you held trades for too long. If you really want to bolster your trading account from your own psychology, create checklists, which we'll cover in another video, with fully set up stop losses and profit targets for every trade. Become a machine, run this thing like a business that can be systematized and boiled down to a process, rather than an exhilarating but ultimately deadly roller coaster ride. At the end of the day, the academic studies we covered today literally prove psychological biases kill more accounts than bad strategies alone. The instincts that kept your ancestors alive evolving for survival rather than trading profits quite literally drain your account and make you poor. The 1 to 3% who do actually succeed might or might not actually have better strategies, but what they do have is they've learned how to put a leash on the flawed ape brain that we all instinctively have. Which of these biases hit you the hardest? Let me know in the comments if this breakdown was helpful. Hit that like and subscribe for more GigaStocks content in the future, and I'll see you soon.